Most traders think the market moves because buyers and sellers are fighting for direction. But what if I tell you that before many big moves happen, the market first needs to create a reason for traders to enter the wrong side? Because price doesn't just find liquidity. Sometimes it engineers it. And this is where most traders become the liquidity for someone else's trade. Today, we are breaking down liquidity engineering, how the market creates attractive setups, builds confidence in traders, and then uses that positioning to fuel the real move. Liquidity engineering is basically the process where price action creates a specific structure that encourages traders to place their orders in predictable areas. The market is not randomly moving up and down. Many times, it is creating a situation where traders see something obvious, a clear breakout, a perfect support, a clean resistance, something that looks so convincing that everyone wants to participate. But the interesting part is this. The more obvious the setup becomes, the more liquidity starts building around it. And smart money understands this. They know where traders are likely to place their stop losses. They know where breakout traders will enter. They know where emotional traders will chase the move. So instead of immediately moving toward the final target, price often creates a path that collects those orders first. One of the most common forms of liquidity engineering is creating a false sense of confirmation. The market gives traders exactly what they want to see. For example, a resistance level breaks, a strong bullish candle appears. Everyone starts thinking the breakout is confirmed. Traders enter late, stops are placed below the breakout area. But then, price quickly reverses. It takes the liquidity below, and after that, the real move begins. This is why many traders feel like every time I enter, the market goes against me. The problem is not always the entry. Sometimes, the entry is exactly where the market wanted you to enter. Another important part of liquidity engineering is understanding accumulation and preparation. Before a major move, price often spends time creating a structure. It may move sideways, it may create equal highs or equal lows, it may form repeated tests of a specific area. To inexperienced traders, this looks like a boring market, but to experienced traders, this is information. The market is building positions, it is creating expectations, it is making traders believe that a certain scenario is more likely. Because once enough traders are positioned on one side, the market has the fuel to move. Now let's talk about one of the biggest mistakes traders make. They only look at where price is going. They don't ask why price needs to go there. For example, a trader sees a bullish setup and asks, where can I buy? But a smarter question is, where are the orders sitting before this move happens? Because price often moves from one liquidity area to another. It does not move randomly. It moves because there is a reason. And liquidity engineering helps you understand that reason. Another important concept is that liquidity engineering does not mean every manipulation is intentional or that every candle is created by some hidden force. The market is simply a place where thousands of participants make decisions based on similar information. Because human behavior is predictable, certain patterns naturally appear again and again. Traders place stops in similar locations. They react emotionally in similar ways. And these repeated behaviors create opportunities. So, how do we identify liquidity engineering on a chart? First, look for obvious areas. The places where almost everyone can see the same thing. Equal highs, equal lows, clean support and resistance, trendline breaks, obvious breakout zones. These areas attract attention, and attention creates orders. Second, look for the reaction after price reaches those areas. Did price strongly continue, or did it reject quickly? A fast rejection after taking liquidity can be an important clue, because it shows that price was not interested in staying there. It was interested in collecting orders. Third, always consider the bigger picture. Liquidity engineering does not work alone. You need context. Where is the overall trend? Where is the higher time frame structure? Where is the next important liquidity target? A liquidity grab against a strong higher time frame direction has a different meaning compared to one happening in the middle of nowhere. Location matters, timing matters, context matters.
Let's talk about a real trading mistake. Many beginners see a liquidity sweep and immediately enter. They think, price took liquidity, so now I buy or sell. But the sweep itself is not the trade. The sweep is information. You still need confirmation. You need to see how price reacts. You need to understand whether the market is showing strength or weakness. A liquidity event tells you where something important happened. It does not automatically tell you your entry. The best traders are not trying to predict every move. They are waiting for the market to reveal its intention. They understand that price often creates a story. First, it attracts traders. Then, it tests their positioning. Then, it shows the real direction. Liquidity engineering is about understanding that story.
So the next time you open a chart, don't only ask, where can price break? Ask, who is waiting there? Who will enter there? Who will place their stop there? Why would price want to reach that area? Because the market often moves toward the places where the most traders are trapped. And once you understand liquidity engineering, you stop seeing the chart as random candles. You start seeing the decisions, emotions, and orders behind those candles. And that is where your market reading starts to change. Thanks for watching. I will see you in the next one.